Every year, our high income and wealthy clients bring us crazy tax reduction ideas for us to evaluate the merits of. And I get it, you hate paying taxes, and part of my job is to put more money in your pocket by devising legitimate tax saving strategies for you to deploy. But we have to be careful because there's a lot of bad actors out there promoting totally sham tax positions and products. Getting involved in these will often lead to an IRS audit, back taxes, interest and penalties, as well as litigation and defense fees. So in short, making an emotional decision about reducing your taxes can be very costly. Here are 5 tax scams circulating the United States social media platforms that you should avoid at all costs. Number 1 is equipment leasing businesses promising big tax losses. Scammers love targeting high-income people because high-income people hate paying taxes. A new scam that has popped up recently is leasing equipment for big tax deductions. What they have you do is set up an LLC, purchase equipment, and then lease it to an operating company under an MSA, a Master Services Agreement. Now, there's nothing technically wrong with leasing equipment and running this type of business, but when you're paying someone else to run the entire show for you, you're not going to get the promised tax benefits that are being marketed to you. The reason for this is thanks to something called the passive activity loss rules found in IRC section 469. These rules say that unless you are materially participating in the business activity, your income and losses will be passive. And because someone else is running the day-to-day on your behalf, there's no way that you can actually materially participate in the equipment leasing business. So the losses that you get from purchasing the equipment, they'll flow to you, but they're gonna be passive. And if you don't have passive income to offset the losses with, then the losses will be suspended on your tax returns and carried forward. Now, the operators will tell you that if you set up your own LLC and you're the sole owner, then you get around the material participation issue. But this is false. The IRS can enact something called the substance over form doctrine when they're auditing you. And this basically enables the IRS to look at the substance of the entire economic transaction and disregard the form, meaning they can totally push aside the structure and instead assess how you participated in the scheme and what your intent was. And what they will find is that you hardly participated at all, and your intent was to avoid taxes, not to run a profitable equipment leasing business. Then they're gonna disallow the losses by making them passive, and you're gonna be looking to sue the operator for providing you with bad tax advice, but they might not even be in business by that point. The second big tax scam that our clients are bringing us right now are solar syndications promising big tax losses and pretty sweet tax credits. Now, this is very similar to the equipment leasing scam that I just covered, but now we're talking about buying solar panels to place on individual buildings or as part of a solar farm. Either way, if you aren't doing the physical work, making all the decisions, inspecting the site on regular intervals, you're just not going to be able to prove that you materially participated in the business activity. So all of the losses from the solar equipment will be passive, and those solar tax credits that you were promised, yeah, those are going to be passive as well, and they're going to be suspended and carried forward. As a side note though, and just to be clear, if you already have a lot of passive income from business investments that you've made, both the solar and the equipment leasing can be great ways to build assets and income streams while simultaneously reducing your passive income from other sources, because these investments will produce passive losses for you. But if you don't have passive income, neither one of these investment choices will help you reduce taxes. Anyone who tells you otherwise does not understand Section 469 and frankly should be avoided when seeking tax advice. Another big scam making the rounds is donating art to claim big tax write-offs. How this works is you buy art at discounted prices and then you get the art immediately appraised for some insanely high valuation. Promoters of this scheme will encourage you to donate the art after waiting at least 1 year to claim a tax deduction for some inflated fair market value, which is significantly higher than the price that you paid for the art. Promoters might suggest that you donate the art annually and allow them to buy a quantity of art that guarantees a specific deductible amount on an annual basis. They might even arrange for certain charities to take the art donation from you. The IRS has a team of professionally trained appraisers, specifically in art appraisal services, who provide assistance and advice to the IRS and taxpayers on valuation questions in connection with personal property and works of art. And while there are legitimate ways to donate art, this scheme is on the IRS's Dirty Dozen list, meaning they are actively auditing and attacking participants. Another big tax scam that we're seeing is tax preparers claiming that you can write off clothes, watches, private chefs, etc. I've seen a lot of bad advice on social media about deducting personal expenses, and it's just really important to understand that eventually you will get audited, you will get caught, you will owe a bunch of back taxes, penalties, and interest. The tax courts have consistently held that deducting items that are inherently personal in nature are not deductible business expenses. You cannot deduct a Rolex and call it a prop. I don't care who tells you that you can. You can't deduct clothes or haircuts because you're a content creator. You cannot fly to some cool destination to film content and then deduct the whole trip as a business trip. And you cannot deduct your personal chef, even if you have business guests over every single night. The fifth big tax scam that we're seeing promoted to our clients are using spendthrift or other trusts to eliminate taxes. If you search social media platforms for how trusts reduce taxes, you're going to find a ton of really terrible advice. You cannot set up a network of trusts to eliminate your income taxes. In fact, routing your income through trusts will generally result in higher taxes, given that trusts have their own tax brackets, and the top tax bracket is reached at only $15,200 of income. Promoters of trust tax elimination schemes will lure you in with complex words and phrases, and they will say that state law matters, and they'll even show you signed opinion letters from attorneys. Do not trust any of this stuff. The promoters make a ton of money when you set up your trusts with them. They're often going to charge you $5,000 to $70,000 to set up the scheme, but the IRS is actively targeting these sham transactions. You will land yourself in hot water and maybe even jail. And a bonus tax scam is paying a tax strategist $30,000 or more for tax advice. There are supposed tax strategists out there who will charge you an insane amount of money for advice that you could get from ChatGPT for free. There are some instances where paying a ton of money like this for advice will make sense. Maybe you make millions of dollars and you've never received any amount of tax planning before. Maybe you're a general partner in a real estate fund and you need a lot of advice and tax compliance setup and structure. Or maybe you're about to sell your business and you need great M&A and tax structuring advice. But for 99% of you, the price tag is not going to make sense for the ROI that you're going to receive. These scammers offering these types of packages are basically really good at marketing. They will find information and deliverables from other firms and they'll repackage them. They will offer you group coaching to make you feel like you have access to the head of the company, but they won't stand behind you in the event of an IRS audit. And I know that for a fact because our firm ends up representing many of their clients when they are later audited by the IRS or the state government. So find a legitimate CPA firm that you can invest in a long-term relationship with that will help you optimize taxes year over year over year for decades and grow your wealth for a long period of time. They should be technically competent and work with people like you. If you have any questions, you want to explore working together, feel free to get on a free consultation with my team, which you can access in the description below this video. We work with thousands of real estate clients across the United States, and we found that most people switch accounts because they're not getting proactive advice from their current CPA. We meet with clients several times a year and build customized tax plans based on your current income streams, assets, and goals, and we're very effective at helping you reduce taxes. My name is Brandon Hall. I'm the CEO of Hall CPA. I hope you enjoyed this video, and I'll know you did if you could do something for me. Comment, like, and subscribe to this channel. I'll see you next time.